In 2026, there's an Indian company sitting on 22,679 crore rupees in cash. No debt, no investors, not 1 rupee of venture capital, ever. It became India's most profitable startup by breaking every rule in the startup playbook. No funding, no ads, no growth targets. And right now, that same company is in trouble. Revenue down 11%, profit down 23%, dethroned as India's #1 broker by a rival that did everything it refused to do. This is the story of Zerodha and whether the most stubborn company in India can survive being right. The story starts with a teenager losing money. Nithin Kamat started trading stocks at 17 on his father's trading account. By his early 20s, he had been through the dot-com crash, and like most retail traders, he had blown up his account. To fund his trading, he worked nights at a call center, selling to American customers on the phone after markets closed, trading his own book by day. For nearly a decade, he lived inside the Indian retail trader's reality, brokers charging commissions as a percentage of every single trade. In the 2000s, full-service brokers charged roughly 0.3 to 0.5% per transaction. Trade 10 lakh rupees, pay thousands in fees, win or lose. The house always won. And the house wasn't the exchange, it was the broker. Nithin's insight wasn't technological, it was moral, almost personal. The broker should not make more money from your trade than you do. In 2010, with his brother Nikhil, a school dropout who left after 10th grade and an even better trader than him, he started a brokerage from Bangalore. Reported starting capital, around 10 lakh rupees. They called it Zerodha, zero plus Rodha, Sanskrit for barrier, zero barriers. Zerodha's launch offer was one line, 20 rupees per trade, flat, whatever the size. That's not a discount, that's a different business model. On a 10 lakh trade, incumbents charge thousands. Zerodha charged 20 rupees for the same execution on the same exchange. Discount broking had existed in America since the 70s. In India in 2010, it was heresy. The incumbents ignored them, because the incumbents' best customers, active traders, were exactly the people Zerodha was built for. Active traders do the math on costs, because costs compound against them on every single trade. They switched first, and they told other traders. Which meant Zerodha's marketing budget could be zero. Not small zero, no ads, no sales targets, no relationship managers. The product was the marketing. Growth was slow for years, and that was fine, because there was no investor demanding it be fast. Remember that, it's the hinge of this whole story. 3 moves turned a discount broker into a machine. Move 1, 2015, free equity delivery. Buy shares and hold them, zero brokerage. Zerodha kept charging 20 rupees only on intraday and derivatives. Long-term investors now had no reason to be anywhere else, and every one of them was a future derivatives customer, at full price. Move 2, they built their own tech. Kite, their in-house trading platform, replaced the licensed clunky terminals everyone else resold. Fast, clean, built by traders for traders. Move 3, the strangest one, Varsity, a free, ad-free education platform teaching markets from zero, no sign-up wall. Why would a broker teach people to trade carefully? Because educated traders survive longer, and surviving traders keep paying 20 rupees a trade. For decades, education wasn't content marketing, it was customer lifetime value engineering. Then COVID happened. Lockdowns, cheap money, a raging bull market. Millions of Indians opened their first Demat account, and the platform they'd heard about from friends was Zerodha. It became India's largest broker by active clients. By financial year 24, revenue hit roughly 10,000 crore rupees, with 5,500 crore in profit. Profit margins north of 50%, without raising a rupee. Here's what makes Zerodha genuinely strange, and it's not the pricing. Every rule of the Indian startup playbook says, raise big, burn big, buy growth, worry about profit later. Zerodha's contemporaries grow up stocks, raised hundreds of millions in venture money and spent heavily on marketing, cricket sponsorships, cashbacks. Zerodha raised nothing. Nithin Kamat's stated reasons, across years of interviews. No investor pressure means no pressure to push customers into trading more than they should. And a brokerage's revenue is a bet on market cycles. You cannot promise an investor growth that depends on a bull market. The founders paid themselves instead, 96 crore rupees each in financial year 25, among the highest salaries in corporate India. Controversial, yes, but it's what profitable and bootstrapped looks like. The money goes to the people who built it, not to a cap table. They even self-assessed their own valuation, around $3.6 billion, deliberately conservative, because with no investors, valuation is just a number for buying back employee stock. For a decade, the heresy worked perfectly. Then two things happened at once. Thing one, the regulator moved. By 2024, Indian retail derivatives trading had become a national concern. The regulator's own studies showed the overwhelming majority of retail F&O traders lose money. So SEBI acted. Bigger minimum contract sizes, 15 lakh rupees, fewer weekly expiries, higher transaction taxes, full option premium, paid upfront. The result? Derivatives turnover fell from 490 trillion rupees in 2024 to 391 trillion in 2025, and retail participation in derivatives collapsed, down more than 77% from its peak. And here's Zerodha's exposure. Those 20 rupee trades that built the empire. The bulk of revenue came from exactly the segment SEBI just shrank. Nithin Kamat had warned about this concentration risk for years, publicly, in his own letters. In the first quarter of financial year 26, he disclosed that brokerage revenue was down 40% year on year. Thing two, the funded rival caught up. Grow, venture-fueled, marketing-heavy, aimed at first-time investors rather than traders. It overtook Zerodha and active clients in October 2023 and kept pulling away. By December 2025, Grow held about 27% of the market. Zerodha's active clients fell from nearly 79 lakh to 69 lakh. Financial year 25 closed with revenue down 11%, profit down 23%, Zerodha's weakest year since the pandemic. The playbook Zerodha refused, raise money, buy users, prioritize scale, is currently winning the market share war. So is this the fall of Zerodha? Look at the balance sheet again. 22,679 crore rupees in cash, zero debt, zero investors who can panic, force a pivot, or demand a down round. A 23% profit decline. Still left 4,237 crore in profit, more than almost any funded startup in India has ever earned, in total. And the company is redeploying, an entry into investment banking, long-horizon investments in fintech and health through Rainmatter, lending products around the broking core. Here's the uncomfortable truth for both sides of the argument. The bootstrap model didn't prevent the crisis. Concentration in derivatives revenue was a known, named risk, and it hit anyway. But the bootstrap model is also the only reason the crisis is survivable at this scale. No burn rate, no runway math, no one to answer to while revenue rebuilds. Grow won the client war spending investor money. Zerodha gets to fight the next decade, spending its own. Two brothers bet that a business which never needs money can outlast any business that always does. The first 15 years proved you can build an empire that way. The next 5 will prove whether you can defend one. If you want the other side of this story, how Grow spent its way to #1, and whether that can ever be profitable, that's the next episode. Subscribe so you don't miss it. Every empire has a balance sheet. We just read it.